Hi there, welcome to our explainer video answering the frequently asked question of what is unrelated business income tax as it relates to an IRA borrowing money to acquire income producing real estate. What you'll learn is that unrelated business income tax is a special tax that an IRA would have to pay for in the circumstance where the IRA borrows money to finance a real estate acquisition. And the percentage of the property that is financed will determine the percentage of the profits that are taxable. And that will be the, as you will see, the net profit on the rental or sale of a property. So for example, if you bought a $100,000 property and you borrowed $50,000, you'd be at around 50% leverage. Therefore, 50% of your net gains would be subject to this unrelated business income tax. If you were only 20% leverage, then only 20% of your net proceeds from the rental or sale of the property would be subject to the unrelated business income tax. So to further describe this, let's show you a brief calculation. Now, this calculation is for explanatory purposes, so there are more details with respect to how to perform the calculations. You'll find that you would fill out what's called a 990T tax return. And so that's the worksheet and the return that you would use to claim the income or losses associated with this unrelated business income tax. We, of course, would encourage you to talk to your CPA or your tax advisor as you encounter these circumstances. So let's use the example of buying a $100,000 rental property with our IRA. Now, you'll learn that solo 401ks operate a little differently with respect to unrelated business income tax. You'll learn that if you qualify for a solo 401k, and not everybody does, but if you do, there's the possibility that you could acquire real estate with debt and you would be exempt from this unrelated business income tax. And we have an entirely different training all on solo 401ks and how this works. Now, be very cautious with that because not all financing will apply to this exemption or qualify for this exemption. So you have to go to section 514 and read up on the specific criteria. For example, if you bought a house on owner financing, the solo 401k would not be exempt from unrelated business income tax. Okay, so back to our example, we buy a $100,000 property with our self-directed IRA. That would be traditional IRA, Roth IRA, SEP IRA, simple IRA. And let's say the IRA is going to make a $50,000 down payment, and then we're going to have a non-recourse loan come in for the $50,000 in financing. So you'll learn that when IRAs borrow money, it must be in the form of what is known as a non-recourse loan. In other words, you as the account owner cannot sign a personal guarantee. In fact, it's considered a prohibited transaction, and we have an entirely different training all on non-recourse loans. All right, so we borrowed $50,000 on the $100,000 acquisition, so our debt finance percentage is 50%. So back to our explanation at the beginning, this is going to mean that 50% of our net profit will be subject to this unrelated business income tax. Now, yes, I did say net profit. So this is one of the circumstances, because we have a tax liability associated with our IRA, that we can actually take advantage of writing off our operating expenses as well as depreciation. So quick calculation for you. Let's look at interest on a property like this. We have utilities, we have taxes, we have insurance, we have repairs, we have property management at $1,200, and our total operating expenses, you'll see here, is $8,376. Now let's assume that we're commanding a $1,000 per month rent. So our gross rent per year is $12,000. And then we have our total operating expenses of $8,376. So one would say, okay, our net gain is $12,000 minus our operating expenses of $8,376. Well, that's not necessarily the case, because this is a rental property and we have the opportunity to take advantage of the depreciation write-off. So let's look at what depreciation would look like on a property like this. So we're using a $100,000 property. We have to factor in that a percentage of that property you cannot depreciate, because you cannot depreciate land. You can only depreciate the building. And there's a calculation that goes into play here looking at the tax assessor's website. But for all intents and purposes, we're going to use 20% of the actual value of the property. So 20% of 100,000 is 20,000, leaving us a value of $80,000. So we have $80,000, and we're going to divide that by the residential depreciation lifespan of 27.5 years. So we have 80,000 divided by 27.5 years, which is going to give us about $2,900. So each year we have this paper loss of $2,900. So we're going to add 8376 to the 2,900 for our total write-off from our $12,000 in rental income. So if we run our calculations here, we have $12,000 in gross rent, and then our total expenses, including depreciation, are going to come out to be $11,276. So that's going to leave us with a net gain. So our net gain is $724. So we have $724 in net proceeds. And remember that only 50% of the proceeds are subject to the unrelated business income tax because we're 50% leverage. So 50% of the 724 is going to come out to be $362. So we have $362 in net proceeds. Now, fortunately, there is what's called a special deduction. The first $1,000 is not subject to this unrelated business income tax. So in this example, the IRA actually pays no tax because it's under $1,000. Now, let's say that figure was $1,500. So we get our $1,000 deduction, and then we have $500 that's exposed to the unrelated business income tax. And so we would then fill out the applicable tax return. And then from there, we would apply that to the estate and trust tax schedule. Now, at that particular rate, we'd be looking at about a 10% tax rate on the $500. So we'd file our return, and then our IRA would pay the applicable tax. So this gives you an example of how unrelated business income tax works with respect to a rental property. Now, if we sell a property with debt financing, of course, we then have to look at what is our long-term gain exposure and then apply that to our calculation. I hope this gives you a better feel for what unrelated business income tax is in the context of an IRA owning income-producing rental properties. Until the next explainer video, keep leveraging compounding interest in the absence of taxation.